The overlapping generations model, or OLG, is a cornerstone of macroeconomic theory, designed to map how consumers distribute their wealth across their lifetimes. Early economic theorists built these dynamic frameworks to understand how capital flows from one generation to the next. But the traditional model has a mechanical flaw. When you introduce stochastic asset bubbles into the equations, the math breaks down. The variables fail to converge into a single predictable outcome. The result is a state of mathematical chaos known as indeterminacy, where multiple, highly inefficient equilibria compete simultaneously. Reality, of course, does not operate in a state of infinite, chaotic possibilities. To make the model reflect actual markets, the baseline OLG model established by Weil in 1987 required a rigorous expansion. We have to inject three specific structural constraints. First, capital accumulation, the probability of a bubble bursting, and strict stock market clearing conditions. The thesis is that by integrating these constraints, we lock in a mathematically unique Pareto-efficient equilibrium. The goal is to show how transforming bubbles into deterministic variables allows us to predict the long-run trajectory of an entire economy. To see how this works, we will trace the derivation from the baseline overlapping generations framework all the way through to a final computational simulation. The target is a specific structural wedge that bubble risk drives right between capital returns and general interest rates. We will map this behavior across three distinct benchmarks: the diamond steady state, the capital bubble path, and the theoretical golden rule steady state. The diamond steady state provides our comparative baseline, a pure capital accumulation model operating completely free of speculative distortion. Securing mathematical certainty within these dynamic models give modern quantitative analysts a reliable diagnostic tool to measure market health. First, we need to construct the economic environment. We start with two generations, Agent T and Agent T+1, whose lifespans physically overlap in a single time period. The core problem for Agent T is dynamic optimization, calculating exactly how much to consume now versus how much to save for their later years. To save, the consumer can allocate their wealth into two distinct investment pools. The first pool consists of capital-backed assets. These generate returns directly from the physical productivity of accumulated capital, like machinery or factories. The second pool holds bubble assets. These are purely speculative instruments that carry market value but offer zero inherent physical yield. If we assume a completely risk-free environment, the consumer's optimal choice calculation treats both pools identically, expecting them to track at the exact same rate of return. Without the threat of loss, the distribution of wealth between productive capital and speculative bubbles is mathematically fluid and entirely arbitrary. That arbitrary balance completely shatters when we formally inject the Banerjee 2021 burst risk parameter into the environment. The derivative of the consumer's optimal choice must physically update to account for the non-zero probability that the speculative asset will suddenly crash to zero. This new mathematical parameter immediately tightens the previously indeterminate solution space. A strict new rule takes effect. The gross rate of return for bubble assets must now inherently calculate a risk premium. To remain viable for the consumer, the bubble asset's mathematical premium must precisely match the exact numerical value of the burst risk parameter. This creates a stark contrast between the highly volatile equation governing the bubble asset and the stable, predictable yield expectations of the physical capital.
Burst risk dictates the mechanics of asset pricing, as investors demand direct mathematical compensation for holding a fragile asset. When we scale that individual consumer choice up to the aggregate level, we see a massive secondary impact on capital accumulation. Historically, baseline OLG models assume that the economy's general interest rate and the capital rental rate operate at perfect parity. This chart maps that initial state of parity, plotting the general interest rate and the capital rental rate perfectly overlapping as a single unified trajectory. When we toggle capital accumulation and burst risk on, those two lines dramatically split apart. This resulting divergence is explicitly defined in the model as the rate return gap. The lower line represents the capital rental rate, which adjusts downward to accurately reflect the true physical productivity of the accumulated capital. The upper line is the general interest rate, which is forced upward by the market to absorb the heavy premium demanded by those stochastic bubbles. The gap represents a mathematical requirement needed to balance any economy carrying burst risk. While the rate return gap explains the divergence in yields, the overarching system of difference equations at this stage still remains unsolved and indeterminate. To close the model, we have to enforce a critical institutional mechanism, strict stock market clearing. The 2023 Banerjee and Pingle mathematical condition enforces this clearing rule at every single time step. During the derivation of the difference equilibrium, the specific constraint locks the supply and demand variables firmly into place. The equations collapse down, entirely eliminating the infinite chaotic paths that plagued the baseline OLG model. The resulting state is Pareto efficient, meaning the equilibrium is optimized so tightly that no single generation can be made better off without directly harming another. Market clearing acts as the final mathematical anchor, dragging a stochastic, highly speculative environment into a rigorous, solvable state. With the algebraic derivation complete, we translate the model into Python and Excel computational simulations to test its predictive power. This phase diagram maps the long-run trajectory of the economy by tracing 3 distinct color-coded curves. The first curve is the diamond no-bubble steady state. This sets the baseline trajectory of pure capital accumulation without any speculative assets. The second curve is the capital bubble path. It plots a higher, risk-adjusted trajectory, driven entirely by the burst risk premium and the rate return gap. The final curve is the golden rule steady state, operating as the strict theoretical benchmark for maximized, sustainable generational consumption. By comparing these curves, we can analyze exactly how the capital bubble path dynamically relates to the golden rule state across extended time horizons. These simulations allow economists to explicitly quantify the long-term drag or acceleration caused by differing assumptions about capital markets. If we check the non-steady state values observed in the simulation, the mathematical model accurately tracks the transition dynamics of the economy long before equilibrium is ever reached. The data proves the core structural reality. Introducing a risk-bearing asset forces a permanent mathematical wedge between general interest rates and capital returns. These rigorous mathematical findings map directly onto the physical reality of centralized trading hubs, where abstract theories dictate real-world asset pricing. By integrating stock market clearing and burst risk into overlapping generations frameworks, asset bubbles are transformed from a source of theoretical chaos into a mathematically deterministic, Pareto-efficient system.